As of January 23, 2026, the silver market has undergone one of the most dramatic transformations in modern commodity history. Silver has surged to unprecedented levels, breaking through the $100 per ounce milestone for the first time ever. Spot prices have fluctuated around $99–$102 per troy ounce in recent trading sessions, with intraday highs pushing toward $102 plus amid continued momentum. This represents an extraordinary gain of over 200 to 230% year-over-year from early 2025 levels, around $30–$35 per ounce, and marks silver's strongest performance in decades, outpacing even gold's impressive rally toward $5,000 per ounce. This parabolic move reflects a convergence of structural fundamentals, macroeconomic tailwinds, and speculative fervor. Silver's dual role, as both a precious metal safe haven and a critical industrial commodity, has amplified its upside in a way gold cannot match. Below is a comprehensive analysis of the key drivers, market dynamics, risks, and outlook for silver in 2026 and beyond. Historical context and the 2025-2026 rally. Silver's price languished in the $20 to $30 range for much of the early 2020s, constrained by post-pandemic inventory overhangs and muted industrial recovery. However, 2025 marked a turning point. The metal surged approximately 140 to 150% for the year, its best annual performance since the late 1970s. This momentum carried into 2026, with prices accelerating from around $70 to $80 at year start to the current triple-digit territory. Key catalysts included persistent structural supply deficits accumulating since 2021, explosive growth in green energy and technology demand, geopolitical uncertainty and monetary policy shifts favoring non-yielding assets, a historic short squeeze in paper markets, exacerbated by physical delivery pressures and China's export controls on silver implemented in early 2026. The rally has been characterized by extreme volatility, with silver amplifying gold's moves due to its smaller market size and higher beta. The gold-to-silver ratio, historically averaging around 60 to 80 to 1 in recent decades, has compressed significantly, reflecting silver's outperformance. Supply dynamics, chronic deficits, and limited elasticity. Global silver supply remains remarkably inelastic. Mine production in 2024-2025 hovered around 820 million ounces (MOs) annually, with only marginal growth expected in 2026, approximately 825 MOs, or plus 0.3%. Most silver, approximately 70 to 75%, is a byproduct of copper, lead, zinc, and gold mining, meaning output responds slowly to silver-specific price signals. Recent company updates highlight this. Major producers like Pan American Silver and Endeavor Silver project modest increases in attributable production for 2026. For example, Pan American targeting 25 to 27 MOs silver. Overall, primary silver mines contribute only about 28% of total supply. Inventories have drawn down sharply. LBMA and COMEX-eligible stocks have declined significantly, with leasing rates spiking to levels indicating physical tightness. For example, one-month lease rates near 8% in early 2026. China's new export controls, effective January 2026, have further restricted flows, potentially removing thousands of tons from Western markets annually. The Silver Institute and other analysts project ongoing deficits, 95 to 200 MOs annually in recent years, with cumulative shortfalls exceeding 800 MOs since 2021. This structural imbalance has forced reliance on above-ground stocks, but those are depleting rapidly, creating a classic supply crunch. Demand drivers, industrial dominance in the green transition. Industrial demand now accounts for over 60% of total silver consumption, up from historical norms, surpassing investment and jewelry. This shift has made silver more economically sensitive while providing a powerful secular tailwind. Key sectors fueling 2026 demand: solar photovoltaics, PV, the largest single driver. Global solar capacity additions are accelerating, with forecasts for 665 gigawatts in 2026, requiring 120 to 125 mu-sounds of silver for conductive paste in panels. Cumulative demand from renewables could push solar toward 200 to 250 mu-sound annually by decade's end. Electric vehicles, EVs, and automotive. EVs use 25 to 50 grams of silver per vehicle, versus 15 to 28 grams for ICE vehicles, for wiring, batteries, and sensors. With production ramping to 14 to 15 million units in 2026, automotive demand could add 70 to 75 mu-sounds, with EVs overtaking traditional vehicles by 2027. AI, data centers, and electronics. The AI boom demands massive data center builds, consuming silver in high-conductivity applications. Estimates suggest US and China data centers alone used hundreds of millions of ounces in 2025, with growth continuing. Grid upgrades and 5G/electronics add further pressure. Other. Nuclear power, control rods, medical, and brazing alloys contribute incrementally. Total industrial demand is projected to grow 10 to 12% in 2026, potentially exceeding 700 to 800 mosarones, while overall demand remains above 1.1 to 1.2 billion ounces. This mismatch with stagnant supply underpins the bull case. Macro and investment factors. Silver benefits from a supportive macro environment. Expectations of Federal Reserve rate cuts, or pauses with dovish tilt, reduce the opportunity cost of holding non-yielding assets. Geopolitical risks, for example, U.S. policy unpredictability, global tensions, drive safe haven flows. A weaker dollar and fiscal concerns boost commodity appeal. Retail and ETF inflows have surged, with physical buying and short squeezes amplifying gains. Central banks and emerging markets are increasingly viewing silver as a strategic asset alongside gold. Price outlook and analyst forecasts. The market's trajectory points to continued strength, though with heightened volatility. Bullish scenarios target $120 to $175 plus dollars in 2026, driven by sustained deficits and industrial momentum. Some optimistic views, for example, ratio compression to historical lows, suggest even higher peaks. More conservative forecasts include average prices in the $55 to $70 range, for example, HSBC, Saxo Bank. Bull targets from B of A scenarios implying $135 to $309 if ratios revert. Technical levels show no clear resistance beyond psychological barriers like $100 to $120, with pullbacks likely bought aggressively. Risks and challenges. Despite the bullish setup, risks abound. Economic slowdown could curb industrial demand, for example, delayed solar EV projects. Supply relief from higher prices stimulating marginal production. Sharp corrections due to overbought conditions and leveraged positioning. Policy shifts, tighter rates, hitting silver harder than gold. Silver's higher volatility means drawdowns of 20 to 30% are possible, even in a bull market. Finally, silver in 2026 stands at a pivotal juncture, a critical industrial metal in the energy transition, trapped in multi-year deficits and riding a wave of monetary and speculative demand. The breach of $100 per ounce is not a fleeting spike, but a repricing reflecting fundamental scarcity amid exploding usage in solar, EVs, AI, and beyond. While volatility remains a hallmark, the structural case suggests silver could continue outperforming broader markets and even gold in the near term. Investors should approach with caution, position sizing for volatility, focusing on physical or well-managed miners, but the asymmetry favors upside in this supply-constrained environment. The white metals breakout may prove to be one of the defining commodity stories of the decade.